Just 1 year ago, many were writing Intel's obituary. Buried under massive losses and fierce competition, the once dominant chipmaker seemed like a relic of the past. But today, we have a stunning plot twist. Intel's Q3 2025 earnings are out, and they're not just good. They signal what could be the most significant turnaround story in tech right now. The stock jumped 8% on the news, but is this rally built to last? In this video, we're ripping apart the report to answer the critical questions. Is Intel finally back on solid ground? And more importantly, what does this mean for your portfolio? Let's dive in. Intel Corporation is a globally recognized American technology company and the world's leading designer and manufacturer of semiconductor chips, most famously its central processing units, CPUs, for computers. For decades, Intel's x86 architecture has been the fundamental foundation of the vast majority of personal computers and servers, establishing a dominant market position through its close partnership with Microsoft in the Wintel Alliance. The company's core business revolves around research, development, and production of the critical hardware components that serve as the computational engines for an array of computing devices. While its identity is deeply tied to the PC market, its product portfolio has expanded to include other essential technologies. In recent years, Intel has strategically broadened its focus beyond CPUs to adapt to the evolving technology landscape. The company is a major producer of hardware for data centers, including servers, networking components, and storage solutions, which are crucial for cloud computing and enterprise infrastructure. Furthermore, Intel manufactures other key components like chipsets, integrated graphics processors, and system-on-a-chip products for a diverse range of applications, from Internet of Things devices to automotive systems. Facing intense competition, Intel continues to invest heavily in advanced manufacturing processes and is pursuing ambitious plans to become a leading foundry, manufacturing chips for other companies alongside its own designs.
First, let's look at the headline numbers that sent shockwaves through the market. The company reported revenue of $13.7 billion, beating estimates. But the real showstopper is here, a GAAP net income of $4.1 billion. Let that sink in. This is a staggering swing from the $16.6 billion loss they reported in the same quarter last year. This isn't just a recovery, it's a resurrection. Earnings per share came in at 90 cents GAAP and a non-GAAP 23 cents, completely shattering the meager 0.01 cents Wall Street was expecting. So, how did they pull this off? 3 words: artificial intelligence and efficiency. The new CEO, Lip-Bu Tan, stated plainly that AI is accelerating demand for compute. This isn't just about NVIDIA anymore. Intel is catching the wave with its AI-enabled PCs, server CPUs, and custom AI accelerators. But perhaps the most unsung hero of this report is the gross margin, climbing to 38%, its highest level this year. This reflects brutal cost-cutting and a better product mix. Remember that $10 billion cost-saving target? Intel now says it will hit it ahead of schedule. Breaking it down by division, the Client Computing Group, your laptops and PCs, saw revenue up 5%, fueled by the new AI PC refresh cycle. The Data Center and AI Group was flat, but showing signs of life with increasing orders. And the big bet, Intel Foundry Services, is gaining early momentum with new US and European clients, targeting a critical break-even point by late 2026.
Now, let's talk about the elephant in the room, the balance sheet. For years, Intel's massive debt and spending have been a major concern. Well, CFO David Zinsner proudly highlighted a significantly stronger balance sheet. How? Through strategic divestments. The sales of its stakes in Altera and Mobileye have unlocked cash, leading to positive free cash flow for the 3rd straight quarter and reduced debt. This financial discipline is giving investors a huge sigh of relief. But before we get carried away, we have to address the caution flags. Because in investing, the devil is always in the details. The Q4 outlook was softer than expected. The company guided for revenue between $12.8 and $13.8 billion and an EPS of only 0.08, below the 0.10 analysts were hoping for. This reminds us that the recovery is still in its early innings and faces stiff competition. And let's not forget the massive $27 billion CapEx program still underway. Intel is betting the farm on its advanced manufacturing nodes like Intel 18A. This spending is essential to compete with TSMC, but it remains a high-risk, capital-intensive gamble. Analysts are largely viewing this as a definite turning point for Intel. The return to profitability is real. The AI tailwind is providing a lift, and cost controls are working. However, the consensus is one of cautious optimism. The real test won't be this quarter, or even next. The true measure of Intel's comeback will be its ability to execute on its 2026-2027 roadmap, expand margins, and finally make its foundry dream a profitable reality. Behind the headlines of AI growth and a recovering PC market lie immense risks that could make or break Intel's future.
First, competition. Intel isn't just fighting one rival, it's in a multi-front war. In the critical data center and AI accelerator space, NVIDIA isn't just leading, it's dominating with its powerful hardware and, more importantly, its entrenched CUDA software ecosystem. AMD is also steadily gaining share. Now, Intel's Gauge 3 and Ponte Vecchio chips are promising, but they still lack the widespread developer adoption and performance consistency to seriously challenge NVIDIA's reign. Meanwhile, in the client PC market, the world is moving away from the x86 architecture Intel built its empire on. Apple's M-series chips have proven the power of ARM-based design, and Qualcomm is following suit with competitive new chips, directly threatening Intel's core business. And underpinning all of this is the manufacturing race. Intel's future depends on its advanced nodes, Intel 3 and 18A, catching up and surpassing TSMC and Samsung. Any further delays here wouldn't just hurt their own products, it would completely derail their ambitious plan to become a major foundry, building chips for other companies. Which brings us to risk number 2, AI market dynamics. Intel has gone all in on AI, pivoting hard to prioritize AI servers and accelerators. It's a necessary bet, but a risky one. Why? Because the AI hardware market is getting crowded. The biggest customers, Amazon, Google, and Microsoft, are increasingly designing their own proprietary AI chips. This trend could severely limit the demand for off-the-shelf solutions from companies like Intel. As one analyst pointed out, Intel is betting on a diversified AI demand, from AI PCs to custom ASICs and foundry work. But this early-stage dependence makes the company incredibly vulnerable. If enterprise spending on AI slows down even slightly, Intel's growth engine could sputter. And finally, the biggest number on the board, $27 billion. That's Intel's planned capital expenditure for 2025, a massive jump from the year before. This money is fueling their fab expansion and the development of those advanced nodes. It's the cost of admission to compete at the highest level.
But this spending comes with severe risks. First, their foundry business is still deeply in the red, reporting an operating loss of over $2 billion last quarter. Turning this into a profitable venture is taking longer than hoped. There is a real threat of overcapacity. If Intel builds all this manufacturing muscle but fails to attract enough external clients for its foundry services, it will be left with enormous expensive factories without enough work. And this entire plan is partially dependent on U.S. government subsidies. While helpful, this introduces political and fiscal uncertainty, with some deals even risking dilution for existing shareholders. If you look at the overall consensus from over 30 analysts, the picture is cautious. The average rating sits at hold or even reduce. Out of 32 analysts polled, only 2 are saying buy. A massive 23 are recommending hold, and 7 are outright saying sell. But perhaps the most telling statistic is the price target. The average analyst believes Intel is worth about $27 to $29 per share. That implies the potential downside of 23% to 30% from its current price. Now, targets range wildly, from a bearish low of 14 all the way up to a bullish 43. But the central tendency is clear. Most professionals see the stock as overvalued here.
The skepticism was perfectly illustrated by BofA Securities, who actually downgraded Intel to underperform even as the stock was rising, specifically citing these execution risks.
Now, let's be fair. It's not all doom and gloom. The positive views on Intel are based on genuine progress. The bulls see value in the historic restructuring. They point to improving gross margins and better cash flow generation. They believe that if Intel can successfully execute its IDM 2.0 strategy and start winning market share, the current stock price will look like a bargain in hindsight. The recent price rally is a direct result of these green shoots. So, we're left with a classic investment dilemma. On one hand, you have promising current fundamentals and a powerful tailwind from the AI market. On the other, you have significant long-term hurdles that are far from being cleared. The overall conclusion from the analyst community is that Intel is a mixed proposition. Most are recommending a hold or a very cautious stance. Their message is essentially, we see the progress, but we're not convinced yet. Wait for clearer, more durable signs that this turnaround is solid before committing new money at these levels. What's your take on Intel's comeback? Are you bullish on their strategy, or do you see the risks as too great? Let us know in the comments below. And don't forget to subscribe for more deep dives into the companies shaping our future. Thanks for watching.